SPACs, or special purpose acquisition companies, have been all the rage, and even people like Shaq have been involved with SPACs. Now, SPAC investing, they're not all created the same, meaning that there's some SPACs that are probably garbage based on the management and their history in the finance world versus SPACs that actually have a good management team and are looking for good target companies. In this video, we're going to be talking about a way that I see to invest in SPACs through a option strategy. And this way you can actually make money or generate income with lowering your risk at the same time. So let's get into it. From a definition standpoint, a SPAC is essentially a company that raises capital or has cash and acquires an existing company. This allows a private company to actually go public through a SPAC. Some examples of companies going this route would be DraftKings, Nikola Motors, and even companies like Tattooed Chef. That's also why they're known as blank check companies, because they're essentially sitting on a pile of cash looking to acquire a private company that wants to go public, and if they don't do that within 2 years, they have to return that money back to investors. So let's talk about net asset value. So when these companies are created, they're taking money from investors and looking for these deals or acquisitions. Now, the net asset value is essentially the value that's within that fund. So here's an example down here saying if there's $100 million in the fund and there's 10 million shares, the value of each share would be $10, or the net asset value per share would be $10. So this net asset value per share is kind of a floor for the pricing. So if you're buying shares at $10 in a year, if they don't acquire anyone and they return money to everyone, you get $10 per share right back into your pocket. So it's not like if you invest at 10, it's really gonna go to zero. There's kind of a limit of how much money you can lose. But here's the crazy thing about SPACs right now, and it's been going on for a while. These SPACs are trading above net asset value pretty much when they're announced. And even before an acquisition target is mentioned, you're getting volatility in these stocks above net asset value. So it may be fluctuating from $11 to $13, back to $10.50, back to $13. These stocks are trading, and when they have options, those options have higher implied volatility. So let's talk about the opportunity I see to make some money off of this volatility. My strategy is a Theta Decay strategy, meaning that I'm buying 100 shares of these SPACs and then selling a call against those 100 shares. So it's a covered position, aka covered call. And here's the thing, if you look at the year-to-date chart for Ajax, you'll see that the price actually does fluctuate quite a bit, even though the company hasn't necessarily announced an acquisition target. So they traded down to $11.30 and it's currently trading at $13.40. If you go to the special acquisition company's website, you'll see the management team, as well as strategic advisors such as Steve Ells, who was involved with Chipotle, James Morgan McEvely, who was involved with Square, and even people like Kevin Systrom, who was former CEO and co-founder of Instagram. They also list out their potential targets, so they're looking for companies that fit in a certain sector, whether that's internet, software, fintech, or consumer sectors. When it comes to Ajax, it also has options, so not every SPAC has options. So this strategy really only works for those with an option chain. So if we look at the March 19th expiration and look at just the $15 calls, you have a bid of 95 cents and an ask of $1.25, meaning that if you traded that mid-price, it would be around $110 for that option. So since we're selling that call, we'd be collecting $110 and buying 100 shares at $13.41. So if you do the math, that means that you're buying 100 shares at $13.41, or $1,341, and you're collecting 110. So your max loss would be $12.31. But since a SPAC really can't go below 1,000 because of the net asset value, your max loss in my eyes is $231. This strategy is bullish, meaning that you make money from price appreciation and the call that you sold. So if the stock went to $15 or over $15, your upside would be maxed out. So you'd make $159 from price appreciation in the stock, $110 for the call sold, for a total of $269 in 33 days, meaning that your ROI for that trade would be around 20%, or analyzed at 221%. Now let's say the stock doesn't go anywhere and it keeps on trading at $13.41. Since the call you sold isn't in the money, no one's going to exercise that, and you basically keep the $110. So you'd get the $110 divided by $13.41, or 8% return in 33 days, or 90% annualized. When you look at it from a ROI perspective on an annualized basis, you can see 90% or 220%. Those are some ridiculous percentages for what you're doing, or the amount of risk that I see that you're taking. And this is something where if you sell a call and it doesn't move for a month, you'd sell another call, collect more money, and you'd lower your cost basis lower than that $13.41 or the $231 that you're kind of risking. So as it goes on and implied volatility is still in those options, you can basically keep on collecting money. And if a target is announced, you'll get a spike in price, hopefully, and you may be called away, meaning that your 100 shares that you own get called away because you sold that call. And I know you're thinking, Colin, you genius, you found a way to make free money. Well, there's always risks, and obviously if the SPAC returns back to $10 instantly, as soon as you sold that covered call, you'd be losing money. And in order to make back that money, you'd need a spike in price, or you need to continue to sell covered calls in order to lower your cost basis. Now, here are some other risks that I've identified. There are three main risks I see. You buy it close to NAV, or net asset value, and the SPAC is never acquired. That means that you're basically losing time value of money. But in this case, if we're selling calls, we're still collecting money. And if we redeem back at 10, we have collected all those premiums over time, and we redeem the net asset value. Now, the second item is where I see a lot of risk. If you buy higher than net asset value and the SPAC never gets acquired, then you lost money on the shares as it goes basically back to net asset value, and you lose it out on the time value of money. So if you implement this strategy on, say, something that's trading at $17 already, and the net asset value is 10, your risk is much higher in these trades. Whereas if you're playing around when the shares are close to $11 to $12, your risk is dramatically lowered if you still believe in the management team and the company as a whole. And then the third risk that I see is a deal announcement is made, you decide not to redeem the net asset value based on the acquisition target, and all the other investors think that company is absolute garbage and they don't want anything to do with it. So it actually goes below net asset value, and you can lose money that way. And I'll go ahead and link this SEC article that explains the ins and outs of SPACs as well. Here's the summarized version of the strategy. You're looking for a SPAC that is relatively close to net asset value, a SPAC that has options to actually sell. You're looking for a SPAC that has a good management team and not someone that has no experience with the finance world or investing, aka people like Shaq. And then fourth, you're looking for a sector that you're actually interested in. So if the SPAC is looking for a healthcare candidate or a target, and that's something that you have no interest in, then you wouldn't be playing around with that SPAC. Also, I don't think this will last forever. What we're seeing right now is a frenzy in the SPAC game, meaning that implied volatility for these options are higher because we're seeing this volatility. You're getting spikes on announcements, and I don't think this will be the norm 3 years from now. As good private companies are taken public, the pool of good companies left kind of goes away. And I think what will happen is eventually SPACs will fizzle out, meaning that a SPAC will be announced and it will basically trade close to net asset value, but it won't see this volatility, it won't see spikes, and until you get an acquisition of a really good private company, SPACs will be more of just a way to park cash. So right now is an interesting situation. I'm kind of trying to play into it until, it stops working. If you guys did enjoy this video and learned something new, please consider giving it a like and subscribing to Main Street Wolf. Thanks guys for watching, and have a great day.